What is your process for conducting a business appraisal?
For retirement-owned businesses, generally what happens is that people are referred to me, uh, or they've already worked with me and they give me a call or send me an email and say, I need a business appraisal. I send them a questionnaire, or if they're on the phone, I talk to them about it. And, one of the questions is, well, why do you think you need a business appraisal? Um, because there are times that the TPA has said, you need an appraisal for this reason, and I don't think it's necessary. I'm always happy to do the appraisal, but most of
Mhm.
most of our clients are very small businesses who don't have a lot of money to spend. So
Yeah.
the first thing I do is try to figure out whether or not they actually need an appraisal. For example, um, we have people who are selling their business to a third party, and
Mhm.
sometimes the TPA will say, "Oh, you need an appraisal for that," and you have to have the appraiser set the price for that sale, and that's not the case. I mean, that's
Right.
that's all just business judgment, and so knowing that, I'll say to the person, well, you are going to need an appraisal after you sell this thing, but you don't need it before, so it becomes a timing issue and it also becomes, a cost issue. In that conversation, I'll figure out, well, okay, this is what I need and this is what my price is, and then they will send me mostly what I want are financial documents. The price
Yeah.
that I charge for an ongoing business with revenues of $1 million that's selling is a different price from a company that is a C corporation that is the remnant of an operating business where
Mhm.
they have sold the company and now it's essentially a pile of money that exists that needs to go back into the retirement plan. We get the items, I review, we reach out, I draft the report, and we generally provide the report to the client and to the TPA at the same time. And then the TPA takes it from there. They will deal with the issuance of stock. Someone else will deal with moving the money. There are moments where clients will call and say, "Well, I disagree with something," and I will always entertain, if there was information that I didn't get, because I will
Mhm.
take information, and sometimes people won't tell me things, or they will forget that, oh, we happen to have our, the reports we showed you didn't have our $600,000 worth of receivables
Yeah.
on
Right.
that report. I will, in
Yeah.
any case where there is um, information that had not been previously disclosed to me that I had relied on, I'm generally willing to adjust reports
Oh,
in
right.
those instances. If someone makes a good argument for saying that the report should be higher or lower because of some factor that I hadn't really
Right.
taken into account, I'm
Yeah.
always willing to
And
look at it.
and what's the sort of timeline of a typical appraisal from scratch? Not a refresher
Hmm.
update, but an actual like new appraisal for you.
We try to get them out in about 3 weeks. I have a queue, and I have done them in 2 days or less if I have to, if it's a rush. Um, there was an October 15th deadline that
Oh,
was
yeah.
recent, and so I recently did a number of appraisals where I turned it around in a day or two, just
Oh my
because,
goodness.
yeah, just that's what happens when the deadlines come up. Uh,
Right.
but but because of just workflow, it generally takes us a little bit more time.
Right.
Slightly, for a Rob's business, $1 million in revenue is reasonably large from what I see.
Mhm.
And for a business like that, it might take us a couple days because in those instances, we get the financials into a spreadsheet, and that takes a little time to make
Ah.
happen.
Mhm. Oh, okay.
And but yeah, so in general, our turnaround is like 3 weeks. Part of an appraisal is telling a story about a business, but the
Mhm.
reality is for the rollover business that it's a lot of franchises and a lot
Right.
of things that I've seen before. So if someone says to me, I have a Jersey Mike's franchise,
Oh, yeah.
I don't really have to, I just, I don't really have to ask about that business. I just need to
Yeah.
know what the financials are to be able to look at it. And then, and then I'll look at the financials. If I have any questions, if something looks odd to me, we'll have a conversation about that and I'll draft the report and I'll send it on. The interesting thing about rollover business valuations is that in certain instances, people don't, they're not 100% invested in what things say, right? I
Mhm.
mean, if
Yeah.
you have a business that is 100% owned by the plan and you're looking to invest more, have the plan invest more money,
Yeah.
it doesn't matter to you if if the equity is worth $150,000 or
Yeah. Do
$200,000.
you have a questionnaire that you provide to people, or or are your questions rather open-ended?
Certainly, life events as it concerns owners or very key people, I would want to know about.
Right.
Again, would have some sort of impact probably on value.
Right.
I have a due diligence list and with it an attached questionnaire. The due diligence list is 1 page long. It has all the stuff that I'm required to ask for.
Mm-hmm.
Nobody ever gives me everything that's on that list, but certainly there's some things that are more important than others. Attached to that is a questionnaire on the company itself. To start the process, there's a long discussion with the client. By the way, I always tell a client at any point along the process, if you have questions,
Yeah.
call me and I will answer your questions for you. But I send initially, after the discussion, I send a contract questions document with questions that need to be answered in order for me to draw up a contract. I
Mhm.
send a due diligence list with the questionnaire, and I send a projections worksheet. And this is an Excel document that I put together. I mentioned early on in this discussion here that clients are usually pretty good at what they do, but usually they don't have a strong financial background.
Right.
Some don't have any financial background. This projections worksheet, it used to be much more complex a long time ago. I was getting back blank documents
Right.
or documents that I simply could not use. And
Mm-hmm.
so I scaled it down and scaled it down and scaled it down, and now it's bare bones. It's 1 sheet long, 3 columns, because I request 3 years.
Ah,
And then I always say again, to those clients that don't have a strong financial background, call me and I'll walk
walk.
you through.
What's the duration of a typical appraisal relationship from beginning to end? How long does it take for you to produce a report, range of time?
Well, if we're talking about a detailed valuation, the most comprehensive, I ordinarily request 2 weeks from the time I get the documents I need, and
Oh,
the fee is up front. But I always say to the clients, I'm as much dependent on you as you are on me. I need to get the documents, and most of the time, the holdups, and again, it's 50% minimum of the time, has to do with the financials. Sometimes the
oh,
stock liquor, but most of the time it has to do with the financials. They're messed up and need to be corrected.
right.
Um, and so if it's tax season, that really drags it out because the CPA is busy
Mhm.
and the clients cannot they'll try,
Yeah.
but in the end, they're better off not wasting their time and just light a fire under their CPA and see if they can get those things corrected.
I wanted to move into the appraisal process now. Our subscribers are listening and watching to learn. They're curious, no doubt, about the process of an appraisal and the product of an appraisal, which is the appraisal report. So, in the order that you wish to tackle these two subjects, I'd like you to describe what information do you require from the business to do an appraisal of its value, and what is in the report.
Well, there's a lot that is required. Obviously, not all of it comes from the business owner
Mhm.
or their CPAs or attorneys or whatever. To simplify it, I put it into four key categories, and I can address some of the other ones later. But in my initial email to clients, I indicate there of the four key categories. First is financial statements. And it's either 5 full years and any potential interim financial statements, or since inception, if it's shorter than the 5 years. Tax returns, internal financial statements, adjustments potentially to those financial statements. And with regard to like non-operating type expenses or non-recurring type expenses. And non-operating type expenses, I jokingly say, is like the company Ferrari, the
Uh-huh.
company Learjet, the company condo in Hawaii, and things like that. I'm not picky at all about small stuff
Mhm.
because I figure that the companies that I'm comparing them to is going to have that sort of stuff in there as well.
Oh,
And
right.
I don't know if that's the view of every appraiser, but that's my view. If it's fairly insignificant, you know, gosh, we spent $100 on a camera or something. Whatever.
Assuming people, do their QuickBooks or something like that, do that bookkeeping accurately, are those reports what you're looking for?
Yes, they can, but garbage in, garbage out. And
Yes, yes.
uh, and what I have found over the years, most of the ROBS program companies are very small companies. If they were large, a lot of times they can get the bank financing or other financing. And they
Right.
don't have to do a ROBS program. So most of them are small companies,
Uh-huh.
and they try and save money,
Mhm.
and they're usually pretty good at what they do. They may not have a financial background. They're certainly
Right.
most all of them are not CPAs.
Mhm.
And so invariably, and probably I'm going to say for these small companies, at minimum, half of the financials that I get are messed up in one way or another. And
Ah,
there's three common errors that are made. Not to say there aren't others, but there's three common errors. One is that the net income on the profit and loss statement does not match the net income in the equity section of the balance sheet.
ah.
Another one is that the stock ledger, common stock,
Mhm.
uh, doesn't match what's on the balance sheet, or you could say it in reverse, which is typically the case. The balance sheet doesn't match the stock ledger.
Okay.
Sometimes it's either or, but most of the time it has to do with the financials. And most of the time it has to do with the fact that the business owners, when they go through the ROBS process and pay the fee to whomever,
Mhm.
they get stock for that. They get shares. And so it should be
Um,
capitalized and it's expensed. And so it's not reflected on the balance sheet
as
uh,
stock. Right.
that they have. So that has to be an adjustment there. The third one is that almost always, well, I said 50% of the time minimum. The balance sheets indicate negative assets like negative accounts receivable or
Oh,
negative accrued liabilities or whatever the case might be. And on the asset side, negative, well, like I say, negative accounts receivable, negative account, whatever it is, it's negative.
oh, okay.
And whether it's an asset or whether it's liability, it's either positive or it's zero. But I have run into situations, a lot of them, where clients don't look at their financials very often. They
Oh, I see.
might do them, but they don't really do their audit so much. And I had a situation here, I guess it was a couple of years ago, and this was a company that had about 13 million in revenue. So it was no small company. Now this was a
Wow.
mergers and acquisitions thing. And I did a valuation for them and sent that valuation off. There was several owners of this company.
Mm-hmm. Yeah.
And they had just got a new CFO. There was a private investment banking group that was interested in buying them. and I knew the principal of that company from long ago, but in any case, they were going to buy this company. And after they saw the financials, they said, we're not going to buy the valuation. They said, we're not going to buy the company. You've got $3 million in debt. The business owner, about a week later, I guess it was, calls me and says, where in the world did you get this $3 million in debt? We don't have any debt.
Uh-huh.
And my reaction initially was panic.
Yeah, right.
Oh my gosh, how could I make an
Right.
error that large? And so I said, hey, I'll look at it. If I made a mistake here,
Hmm.
I'll correct it. So
Right.
I looked at the tax returns. On every one of those tax returns, there was $3 million in debt.
Oh, right.
And
So,
so I indicated to him that I got them from your tax returns. Every
right.
single one of them showed this $3 million in debt. And I never heard from him again
Oh
because
my
he was
gosh.
embarrassed. But here's the thing, to go back to my original point is, you really should look at your financials. They had several owners. It was like 4 or 5 different owners. And in 4 years, they never looked at the balance sheet.
Like
And
nobody did. They didn't have meetings or review or a committee looking at it or anything.
no, a
Okay.
$13 million revenue company.
Wow. Okay.
Uh,
Wow.
yeah. Anyway, so that's a kind of a off the beaten trail here with that.
Right.
But I certainly would advise clients
To,
or anybody to look at their financial
oh
statements.
yeah.